Good morning, everyone. I can see the participants are slowly increasing as we have logged on to the webinar. Thank you for your patience while you've waited just those few moments. Before I start in earnest, I would actually like to start by acknowledging the custodians of our land. So before we begin in earnest today, I would like to first acknowledge the traditional owners of the country in which we work, the Gadigal people of the Eora Nation, and the various lands on which you are all working from today around Australia. We recognise and celebrate their continuing connection to land, waters and culture. We pay our respects to elders, past, present and emerging, and thank them for protecting country since time immemorial. So to kick off today, I would like to welcome all of the investors and advisors who have made the time to join us today for the first of our two-part webinar series on ethical investing in 2022. And what a year it's been. Post the record double-digit returns in 2021 off the back of COVID, this year markets have been volatile from lots of perspectives. And it's been a really challenging period for us as professional investors, but also one that has required your resilience to wait out that market volatility over the course of the last 3 and 6 months in particular. I'm Leah Willis, Head of Client Relationships at Australian Ethical and your host for today's webinar. I also need to provide a general advice warning up front. Today's presentation is an update on financial markets and does contain information about our managed funds. Please know that the information contained in today's presentation is general information only and doesn't take into account your individual investment objectives, financial situation or needs. Before acting on anything in this webinar, you should seek independent financial advice and refer to the FSG, PFS and additional information available on our website at australianethical.com.au. Finally, I would like to update you on some housekeeping for today's webinar. You are sure to have questions, so please send them through the webinar during the webinar using the Q&A button. We will endeavour to answer as many of these as possible, and we will revert to Q&A at the end of this session, but we will ensure that we try and get to everyone's questions either during or post today's webinar. We would also love your feedback, so please keep an eye out in your inbox for an email with a recording of this webinar, more information on our range of managed funds, and a short survey to help us continue to improve these and the information that we deliver to you. And for advisors, we've applied for CPD accreditation for this session via the FPA, and details on how to claim those points will be included in the follow-up of today's session. I'm pleased to introduce our presenters for today who will be leading you through our market update and providing insights to how we have navigated the volatility of the past 12 months while maintaining unwavering commitment to our ethical heritage and long-term investment fundamentals. Mike Murray, our Head of Domestic Equities, joins us. He has over 20 years' experience as a portfolio manager and equities analyst. He joined Australian Ethical in 2016 and now leads our award-winning domestic equities team and range of active Australian equity strategies. Andy Gracey, portfolio manager, joined Australian Ethical in 2004 and has been at the helm as PM of our Australian Shares Fund for more than 16 years and our Emerging Companies Fund since its launch in 2015. His tenure as PM means Andy has led these strategies through all market conditions, and his insights today are invaluable. Deana Mitchell, equities analyst, joined Australian Ethical almost 5 years ago with her focus on small caps, technology and diversified financials. Prior to this, she was at Macquarie for nearly 14 years, doing equities research on the sell side with her sector knowledge spanning financials to small caps. She also headed up ESG research and is passionate about responsible investing. Prior to handing over to the other presenters, I wanted to provide just a very sharp, succinct snapshot of what we do again. And it's important to understand that the ethical charter that underpins everything we do, which you can find on our website, has been around since the inception of our business. But not only do we apply a rigour around our ethical assessment, we equally apply a rigour around our investment fundamentals. So as you can see, our investment philosophy has 3 key components: the ethical assessment that we apply, rigorous investment process we then apply, and also active engagement, making sure that we're actually making a difference with the corporates we invest in, but also through market resolutions and advocacy work we do outside of the fund or the portfolio itself. All of our investments line up to our ethical charter in a way that they have to make a positive difference on society and the environment we live in, but they also need to avoid harm, and we avoid industries which have negative impacts on society, the planet, people, and animals. This means that we have a very different approach. It's a unique approach to any other mainstream manager, but even unique to other responsible investing or sustainable investment options that you may be familiar with. And at the end of the day, the proof or the evidence or the proof point, I guess, of how we invest and the impact we make through the portfolios and the ethical charter that we apply is that we actually have a portfolio that is 77% less carbon intensive than the mainstream indices. We have much more investment in renewable power generation than benchmark. And we also have 2.5 times more impact towards sustainable development goals. So we're actually aligning to make a difference and have an impact on the critical issues that are facing society today. I just wanted to carve out for a moment to say that we will have a follow-up webinar, which is the second part to this series in a couple of weeks. And I would encourage you all to register for that, to do a deep dive on our ethical assessment, our frameworks, and the advocacy and engagement that we've been doing over the past 12 months. But for context today, we're really focusing on the investment fundamentals. It has been a really tough 12 months. So putting that in perspective in terms of what we do, and then also the portfolio outcomes is really important. And just before I hand over to Mike, I'd like to sort of reaffirm the approach that we take to responsible investing is everything must first get through our ethical charter and assessment process. Effectively, that screens out and screens in the investable universe. Our portfolio managers then apply a very bottom-up fundamental approach, much like many other investment managers in the marketplace, where they apply fundamentals to that ethical investment universe. So the context of the last 12 months, our investments do look different. They favour lower carbon, more positive impact sectors, things like healthcare, IT, communications and renewables. And hence we have overweights to different sectors than you would anticipate out of the mainstream indices. Our funds are also typically overweight in small caps with some expansion into the large cap universe. And the market backdrop over the last 12 months is we're in late stages of the economic cycle. Central banks are rapidly playing catch up to kill inflationary pressures. The Ukraine war has exacerbated supply chain issues out of COVID and has driven up commodity and energy prices. And the technology and healthcare sectors have been bid down significantly in the second half of the financial year 22. With that kind of backdrop to how we apply ethics and investments and that kind of economic and market environment, I wanted at this stage to hand over to Mike Murray, our head of domestic equities, that will take you through some of the macro and thematic things that have been driving markets and how that's impacted our portfolios and performance.
Thanks very much, Leah. I'm just waiting for the first slide to come up there. So my name's Mike Murray. I'm head of domestic equities at Australian Ethical, and it's good to be here talking with you today. And look, I really do want to acknowledge it's been a difficult 6 months for investors after some years of positive returns, and I'm going to try to put that into a bit of context for you today before handing over to Andy and Deana, who are senior members of our investment team. But if I was to characterise the last 6 months, it's been, I guess, a market driven by extreme macro volatility in reaction to macro news flow. And I think in many cases what that's meant is that we've seen share prices not trading in line with their long-term fundamentals. And as you can imagine, as a manager that's concerned not only about long-term ethical issues, we're also very concerned when we value companies about the long term rather than the short term. So we are seeing companies not trading in line with their fundamentals. And what's interesting is that we actually know that in the long term, what drives share prices is fundamentals. So in many cases, that when we look back at other cycles like this, whether it be the GFC or the more recent volatility around COVID, we can look back and we can see that those situations presented opportunities for the long-term investor. And so we regularly go and review our portfolio, and when we review it at the moment, we look at it, and in many cases, we examine it on a company-by-company basis, and we don't actually think that the long-term prospects for our companies have changed dramatically from where they were 12 months ago, even though the macro news flow has been so persistent. In fact, in some cases, they're trading cheaper than where they were 12 months ago. So you may argue that the fundamental outlook has actually improved. And then I think there's another dynamic at play here, is that we're also seeing companies adapt their business models to changed external circumstances, and the market often underestimates companies, particularly with good management teams, ability to be agile and adapt to their environment. And so just to give you a really live example, we had the CEO of Suncorp in the office yesterday. They reported their results. The market, the share price at one point was down 6%, and the market was selling the company on what we thought was a reasonably inline result, on the basis that they've had elevated weather experiences, as we all know, living in Australia in the last torrid 12 months. And the market's concerned about that effect on their capital. However, when we look at Suncorp, what we're actually seeing going on is a much more sophisticated pricing and understanding of climate risk, which we actually think is going to serve shareholders better in the long term. So we're seeing the company adapt. And then when we look at the macro environment, we're seeing an environment of high bond yields and inflation, as we all know. Similarly, we actually think that's going to have a positive impact on the ability of Suncorp to generate returns for shareholders in the long term. So that's the sort of company we're looking to add to on weakness, and often we find ourselves having quite a different view when we take into account the long term than the short term. So I'll just jump into a little bit about how we go about our fundamental investment process. Firstly, obviously, ethics sits at the heart of what we do. We start with a sustainable universe. We think it's one of the most sustainable universes because of the rigour with which we apply our ethical screens. But we also think that gives us some long-term advantages because we're exposed to companies with positive structural trends like healthcare and utilities and renewables and information technology. And we don't see those trends changing. A good example of that is, we invested in Pilbara Minerals several years ago, a lithium miner. We don't do much investment in mining, but we were interested in lithium because of its potential in battery technology. So we were very early to look at that. We bought Pilbara at around 70 cents, and look, it subsequently fell to 15 cents. And so it just gives you an idea of the sort of volatility that you can see in the short term. And we're certainly not strangers to that. It's currently trading at $3. So that's actually turned into a very successful investment for anyone that was able to ride out that volatility. And I think we were looking at a company like that because it was a forward-looking industry. But it's really important to note we don't just rely on sort of positive long-term trends to generate investment performance for clients. We know that we have to pay the appropriate price for companies. We have to understand the individual competitive outlook and earnings outlook for every single company that goes into the portfolio. And really, that's most of the time that we allocate to portfolio management investment rather than trying to pick the next inflation number. And then when we put that together, we think if we have a sustainable universe, a deep pool of experience in some of these sectors that are highlighted within our sustainable universe, and if we put that together and play in parts of the market where people aren't doing that really deep research, like in smaller capitalisation stocks, then we can get an edge. And I think, when we put the portfolio together, we don't pay a lot of attention to, the wider index. So just because a company has a big index weight, if we don't agree with the fundamental outlook of that company, we're quite happy to be different, and we've been rewarded for that in the long term. So our portfolios do look very different to mainstream portfolios. We've had long-term positions in healthcare, information technology. And when I say utilities, I really mean renewable utilities, because if you looked at the utility sector in the ASX, you'd find, it was mainly made up of old style sort of gas and electricity and fossil fuel powered utilities. We're actually quite heavy investors in the New Zealand renewable utility sector in geothermal and hydro and wind and so forth. And look, we don't think, even though these sectors have had a tougher 6-month period, we don't think the long-term trends supporting these sectors have changed. I cover the healthcare sector, and it's been a long-term trend around the world for governments to spend more and more money on healthcare through time as the population ages and technology delivers better and better healthcare outcomes. And we certainly see the tailwinds continuing in sectors like that or in IT. We all know how much we're using new sorts of software on a daily basis and how embedded new software is in our lives. On the other hand, certainly some of those sectors that have done well in the last 6 months, like old style fossil fuel related energy, we simply don't invest in that. We don't intend to invest in those sorts of sectors. Sorry, my slides have just jumped forward for some reason. I'll jump them back. And in terms of the, sorry, I seem to have gone forward a slide here, but I'll just keep talking to the prior slide. And in terms of the mining sector, we have quite a low exposure to that sector. And so really that's, for us, that's about scrap metal in the case of Sims Group, which has been a positive investment for us, or I mentioned lithium before. And I'll just try and move on to the next slide here. There seems to be a little bit of a lag. Okay. And so the other part, apart from being different by sector, we are quite different by market capitalisation. So really, this is our menu of Australian share funds. And, on the left-hand side, you have almost a pure small cap fund, our emerging companies fund, which has got a very strong long-term track record. But clearly, it's been impacted in the short term by its overweight to smaller capitalised companies, which have underperformed during the macro sort of volatility that we've had. Our Australian Shares Fund is also quite exposed to smaller cap companies. And in fact, some of its best long-term positions have been generated out of the small cap sector. It's a part of the market we continue to believe in, but clearly also that's had a disproportionate impact on the last 6 months' returns. The high conviction fund's a little bit different. It's a larger cap style fund. It's more concentrated, and we launched that 9 months ago, and I'm the portfolio manager for that strategy. We have seen that fund behave a bit more defensively, as you'd expect, because it is exposed to larger capitalised companies, which have held up better. Just trying to move on to the next slide. And so just a little bit on the macro. I mean, as I said, we don't spend a lot of time trying to predict the next macro event, but it's worth touching on because clearly we've seen this very pronounced jump up in inflation, and the market is spending a lot of energy trying to work out what is the next inflation print going to be, rather than, I think, what the market should be focused on, which is what are the fundamental prospects of the individual companies that we're looking at. Now, having said that, it is a big number. But I think, it's worthwhile remembering before we get too worried about inflation that it wasn't that long ago that the market was very worried about disinflation. And in fact, central banks around the world have been trying to generate inflation for some time. So a little bit of inflation might be a healthy thing. In fact, equity markets do cope quite well with inflation up to a point. And really the debate is all around where does inflation settle and how persistent it is. And of course, why does this matter? It matters because it's had an impact on bond yields. And on the next slide, I have a very long-term chart of the US 10-year bond yields. And you can see there that, we've had really since the 1980s, a sustained downward trend in US bond yields, and that has come to an abrupt halt in the last year with the market thinking that bond yields may need to rise as we've seen inflation. And bond yields matter to equities because people price their long-term cash flows on the back of bond yields. And also interest rates have impacts on broader economic growth. And so what's happened over the 12 months? Look, we've seen the ASX 300, it's fallen around 7% over the 12 months. But it's a tale of many different stories within that. The resource part of the market actually appreciated 3% over that period. The industrials fell slightly more than that, or the large industrials about 7.5%. But you can see there that what has happened is there's been a dramatic flight of capital out of smaller capitalisation companies, and in our experience, that's certainly creating an opportunity at the moment. And then on the right-hand side, you can see by sector, IT, after being one of the leading sectors, has been the worst performing sector over 12 months. And then some of those older style energy and utilities companies I mentioned, really heavily into fossil fuels, and we don't play there. have done well, but you really needed to be in those sectors on a short-term basis in order to have a good year. Just to show you, I guess, to demonstrate how quickly this is moving, if we simply looked at the month of July, information technology was actually the best performing sector. So we're already starting to see some signs that this is turning around. And similarly, we saw a big jump up in the small cap index during July. So it is a very dynamic and volatile environment. If we look, a little bit longer term, you can see on the right-hand side here, that these three lines represent the top line is our emerging companies fund, the light blue line is our Australian shares fund, the yellow line is the ASX 300 benchmark, and the pink line is the small industrials index. It's pleasing to see that our Australian shares fund and emerging companies fund over 3 years are ahead of both those benchmarks in both cases. But you can certainly see that, together with those indices, that they've fallen over the last 6 months. But if we look at that sort of 3-year context, the Australian shares fund has given you about 6.8% per annum versus an ASX 300 of 3.4% per annum. And one of the reasons we've been able to do well is really our exposure to small caps over the long term. And that's really clear when you look at the performance of our kind of pure small cap fund, the emerging companies fund. It's delivered a better return than our broad cap fund. It's delivered around 10% per annum over 3 years, despite the small industrials index going backwards 2.2% per annum. So this really, I think, validates the way we think about small companies and the opportunity for us to generate excess return for investors in small companies. And that comes about because we've got very deep pools of expertise in that part of the market. And often we can find companies that are less well researched that other people aren't looking at and getting them at a later stage. And so where are we now? We certainly think that part of the market looks oversold. If we compare the price to book ratio of the small industrials sector, and we compare the title of this chapter to say the relative price to book ratio of small industrials to large industrials on a historical basis, they're looking at significantly cheap compared to their long-term 10-year average. And that's something we're finding when we go through the portfolio. We certainly are seeing those opportunities at a bottom-up level. We don't talk much about the broader mining sector because we really do only play in the industrials outside of those areas that I mentioned. But I think, I gave the example before of the insurance sector. We think the insurance sector has had some short-term headwinds, but we actually think it's got a really positive long-term outlook. If I look at, the mining sector of it, I think it's had some really positive short-term tailwinds. But the question I have is this as good as it gets? And, you can see that what I've done here is I've averaged the return on equity amongst BHP, Rio Tinto and Fortescue, which all make up big parts of the ASX 300 index. And you can see they've been generating sort of an average return of equity of around 40%, which is around twice their historical level. And I think one of the things that, we're thinking a lot about is that if bond yields do sustain at high levels, and you're starting to see this play out now, you are going to start to see slowdown in economic growth, perhaps less so in Australia, but more so overseas. And so for these kind of global cyclical companies, the concern would be that they're somewhat exposed and that those returns that people have been receiving, or, you're getting a big dividend in the short term, that actually may not be sustainable in the long term. So when it comes to a market outlook, after the sort of correction in the market, we certainly feel more confident about the valuations that we're coming across. It is a dynamic environment with respect to inflation and interest rates, and really those macro influences we think have played a disproportionate role in setting prices. In the long term, we think the market goes back to fundamentals because it always does. Risk aversion in small caps, from what we can see, looks like it might have peaked during June. We're seeing a strong bounce back in that part of the market. This point around, being agile and adapting is really important. Where we invest in smaller cap companies, for example, software, we're definitely seeing a focus on business models pivoting towards free cash flow in favour of growth. And we think the market will reward that. And so we actually think if the company has the business model right, And like in a lot of the cases in sort of software where you've got recurring earnings, we think those are incredibly profitable businesses in the long term. We feel very positive about that. There certainly are parts of the technology sector where we don't think that's the case. You know, we've never played in the buy now, pay later sector. We haven't believed in the business model, and frankly, we haven't really believed in the ethical position of many of those companies either. But where we can buy recurring earnings, smaller cap software companies, we're quite excited about that opportunity. And just a point about economic growth, if we do see economic growth soften, we think that we can position quite defensively because we don't own many of those sort of cyclical companies like those big resource companies which I described. We are overweight companies in the healthcare, communications, renewable sectors, which we think will be more robust in a slowing growth environment. And just finally, look, we've done quite well over time. We've found that there's quite a lot of appetite for some of our companies from corporate transactions. We've already just had a few more, and we think that that provides a backstop to valuations too, if markets sell off much. And just you know, like to leave you with, after a very difficult 6 months, you can see, you know, some of the snapback that's occurred in July. The emerging companies fund up, you know, up around 12%. The Australian shares up over 9%. High conviction fund being more expensive, up a little bit less. So we have, in a very short term, we have some changes. And with that, I'll hand over to Andy Gracey. Thank you.
Thanks very much, Mike. Look, I've been looking after the Australian Shares Fund. I've been involved in portfolio management since 2006 and the full portfolio management role since 2008, while I've been the founding portfolio manager for the Emerging Companies Fund, which commenced in 2015. So we've just rolled over kind of 7-year performance data. So myself and Deana are going to go a little bit deeper in terms of talking about our portfolios, talking about our holdings, and we've also got a few stock examples which we're going to kind of talk through. We also want to kind of show you, how we kind of think about stocks and what we look for in stocks. Australian Shares Fund, this is an all-cap strategy, true to label, responsible fund. It's been around for a long time. Objective is to outperform the S&P ASX 300 over rolling 3-year periods. Just in terms of outperformance, look, we've done that in terms of over the 3 years to 30th of June. Just in terms of breakdown of the portfolio, this is similar kind of data that Mike mentioned. Look, we've got 30% odd in top 100 companies, with finance companies, regional banks, 2 of the big 4 banks, well represented in that, as well as insurance companies. In terms of small companies, represent an important part of our kind of added value strategy. The New Zealand exposure is largely the renewable energy generators in New Zealand. That's Meridian, Mercury and Contact Energy, as well as companies like Fisher & Paykel Healthcare. So these are reasonably large companies. And cash is at 30th of June was 7%. Look, we've made some comments here in terms of, because we are extensive screeners of the market, when we invest, we are, genuinely benchmark unaware. Look, we're looking for opportunities across the full market spectrum. And we've got a very kind of disciplined investment approach in terms of how we go about looking at the screened universe and actually selecting our companies. Just in terms of performance, look, as Mike has alluded to, a difficult period over the 12 months for the Australian Shares Fund, but over longer periods, performance, we've added value over medium and longer term periods. Just in terms of, let's talk about the portfolio construction and some of the names in the portfolios. Look, we've got top 10 exposures there on the left. You can see in terms of on the right, in terms of from a sectorial point of view, where performance has been added and detracted over the 12 months to 30th of June, with with healthcare, information technology, quite significant detractors, and we're going to kind of dive a little bit deeper into IT, with also kind of lowly weights in materials and energy, detracting from investment performance against an ASX 300 benchmark. Just in terms of just going a little bit deeper in that technology space, what we've really seen is some of the smaller cap and micro cap technology companies being disproportionately affected in the sell-off, and fundamentals to a certain extent, we're thrown out the door in terms of in favour of liquidity, and became a liquidity-driven market. We're hopeful, that period has passed, and we've seen quite a powerful kind of rebound in the technology sector in July and August to date. Just in terms of the names that were the top contributors over the 12 months, GrainCorp was a very strong contributor, benefiting from the appreciation of grain prices globally, and particularly on that part of the business where they export grain to international markets. OFX Group was one of our largest contributors. We kind of have held this company for circa 2 years. We followed it for nearly 10 years. We saw an opportunity during COVID in the 120s to 130 levels. We are substantial in that company, and that's kind of doubled over this period. So not all technology-orientated companies have been poor performers. And Macquarie Telecom, this is a long-term holding for us, 10 plus years, and this is an example of in an ideal world, the type of company we want to hold in the portfolio. We really aren't one of these fund managers that's madly buying and selling. We're looking to an ideal company for us is, we hold it for 10 years. We kind of engage with management. We really understand the business, and we let that kind of power of compounding kind of drive returns, as opposed to kind of dancing in and out of stocks in terms of, for small kind of gains. That's really not our kind of style of investing. We're really long-term investors, low turnover. In terms of our detractors, you can see a couple of technology companies there in terms of detracting, as well as a mortgage provider over that period. Just in terms of the second fund that I'm responsible for is the Emerging Companies Fund. This is a small/micro cap strategy. You can see the X 100 in terms of being 80% of the fund. It is a small cap fund, it's not surprising. New Zealand is still reasonably well represented, within that portfolio, and a small amount of cash. Look, we aim to outperform the S&P ASX small industrials. Sorry, it's just jumped ahead. And look, over a 3-year period, the fund is outperformed by 12%. Looking for sustainable businesses, we've got a separate ethical screening process that Leah and Mike have alluded to. Then us as investors come in, and we are fundamental investors. Our areas of focus kind of put the lens on healthcare and information technology, and in areas where we think there's long-term sustainable performance available. Small caps, where we've added value for the Australian Shares Fund. It's where we're adding value at the moment for the Emerging Companies Fund. And we've got some performance here. If we can, okay, Mike. You can see good long-term performance. A really difficult 12 months in terms of the fund is slightly ahead over 12 months, but those numbers just tell you how tough this small industrial space has been over the 12 months. Having said that, July was plus 12%, so you've almost kind of you've clawed back more than kind of half of those, that really kind of negative performance that we saw over the 12 months to 30th of June. Just moving forward. This is the same slide, but talking about the Emerging Companies Fund. Look, we've got our top 10 holdings on the left there. In terms of, we've got some attribution and a pretty similar story, a little bit different because we're attributing performance against a different index. In terms of, this is attributed against the small industrials. You can see IT has been a laggard for our investment performance, as has real estate. Real estate's quite a big part of the small industrials benchmark. We don't have any real estate within the fund at the moment. That's, you know, really focusing on operating companies as opposed to kind of you know, asset plays or NTA and property type plays. Over the 12 months, you know, financials have been a good outperformer, and companies like OFX, which we've talked about, a foreign exchange online trading group, you know, has been a very strong performer, really benefiting from an acquisition undertaken earlier this year, or late last year, earlier this year. The fund has also benefited from merger and acquisition activity. HRL Holdings, which is a small testing company, benefited you know, from a large kind of takeover towards the end of the 2022 financial year. This is a company, you know, we were a substantial shareholder in. We've always kind of seen the value, but the market really struggles with some of these smaller companies in terms of kind of understanding the value, and third party kind of took it over late in the piece. The detractors, look, there's technology and there's medical healthcare there. We're pleased to say, you know, all three of these companies have bounced pretty strongly in July. And okay, I'll just move forward. Oh, look, I'll hand it over to Dee, and hopefully she can kind of shine some light in terms of some of the technology names that we invest in.
Thanks, Andy. So we've just got a sector focus just on technology. It's topical because it has detracted from our performance over the past 12 months, and it is an active overweight across the funds. So we've seen volatility in share prices, inflation, interest rates, and the outlook for the economic environment has changed the appetite for growth sectors such as technology. But that said, we're actually seeing opportunities to selectively add in future building industries. So it's not just in technology, and we'll have 3 examples a little bit later where we'll talk to 3 examples of stocks held in the funds to illustrate this. So we often get asked about the ethics perspective on technology. So our style of investing and charter philosophy leans towards the technology sector as we invest in newer future building industries. And once they pass our ethical screen, we then select our investments in the space with an investment lens. So what are we looking for in technology? We're looking for kind of attractively priced stocks, scalable business models, and backable management teams, particularly important for small caps. So there's a long history of kind of Australian ethical investing in technology, and we ideally are seeking out growing businesses with that high level of recurring revenue. So I've got a list here. It's not necessarily exhaustive, but these are some of the markers that we look out for in this slide. So generally, we tend to prefer and invest in enterprise software models because they tend to be stickier revenue. And so we look at metrics for software in terms of net revenue retention or customer churn. And these are generally indicators to us for the recurring nature of their revenue. Enterprise clients generally, as a general comment, tend to be stickier because the software is embedded into business processes or woven into the fabric of the organisation processes. So we are also seeing these software businesses pushing through price increases, which does provide an inflation hedge of sorts in the current environment. So today, where are we at today? So where share prices are today, we think we're actually buying some software companies at low value relative valuations. So we are seeing opportunities there. We did struggle to justify some of the capital raises at much higher prices last year and didn't participate in some. And we don't own the more expensive, larger cap technologies, as shown in this chart. So we are selective about the holdings and when we choose to buy and sell. Just for reference, the green is the stocks that we do own, and the red is stocks that we don't own. So we tend to own stocks with lower EV to sales multiples, where the stocks are trading at a steep discount to their larger cap technology stocks.
Okay, Dee, I will move forward.
It's probably also, Andy, just before I pass back to you, just talking about the balance sheets within the space as well. So when we are talking to stocks with lower EV to sales multiples, we're also looking at the balance sheets of these companies. And several of these companies had taken advantage of higher share prices to raise equity, which had shored up their balance sheet leading into this period of volatility. So they're in a better position versus other companies that have leaner balance sheets and cash burn. So a funded balance sheet in this environment is especially important because there is a heavy dilutionary impact if there needed to be an equity raise at these depressed levels. And there is limited appetite in equity capital markets at present to fund these. Many of the technology names have also pivoted to bring forward their cash flow break even to protect their balance sheets and shareholders. So Andy, I might hand it back to you then.
Okay, thanks, Dee. Just what we've got here is a slide which kind of goes through some of the thinking involved in terms of selecting the names within the portfolio, and because there's a multitude of factors to think about, and these are very qualitative factors. A lot of our decisions are more qualitatively driven. We have models, we have a very good financial understanding of all companies that we invest in, but in terms of critical thinking and long-term critical thinking, we're definitely looking for companies that will benefit from thematic trends. We're looking for high quality products and services with a long-term commitment to innovation. That's important to us. Mike's alluded to this, Dee's alluded to this. Look, in terms of the business models, we are looking at those kind of more recurring, high GP margin type businesses, ideally, with barriers to entry, owners of IP, companies really strongly positioned. And do we want an east coast of a Australian business? There are some great kind of local businesses, but ideally, from an investor's perspective, we can really make some powerful returns if we've got a company that's taking its IP kind of globally. We've talked about being a fundamental investor. We are a fundamental investor. Every investment we have in the portfolio, is justified by its valuation. Look, in terms of even in this kind of current environment, as Dee's kind of alluded to, companies are pivoting. Companies that last year, the market was very happy to fund them on kind of expectations of burning so much cash in return for top line revenue growth. Those business models are pivoting towards free cash flow generation within the next 12 months. And there's also these kind of X factors within companies, hidden type value, companies that are attractive industries for M&A, where we've seen a number of kind of corporate deals historically, and also board and management, who we trust, people that we like, and remembering that we're looking to work with our investee companies ideally over 10 years. So let's kind of dive into an example in terms of Capital Health. This is a radiology business. It's primarily kind of focused around Victoria. Look, we've been investing in Capital Health for over 5 years. We kind of opportunely, got involved when after the company was over leveraged and it had a big capital raise to make the leverage situation sustainable. The company is trading around 6.5-7 times EV to EBITDA, which is very attractive. locally in terms of compared to other healthcare companies. Look, it's got its balance sheet has very lowly levels of debt, and it has a $100 million facility in terms of. So basically, we've got no debt on the balance sheet, and we've got the opportunity to both kind of grow through greenfields and grow through acquisition. So we've got a valuation here of 33 cents. That's come back on the back, because we are fundamentally valuing companies relative to market multiples, and the market multiple has come back. Having said that, the stock's trading at 28 cents. We can see plenty of kind of acquisitions in the space, and we know private equity is pretty interested in radiology in terms of, and there's been a number of transactions over recent periods. In terms of the weightings, look, the Emerging Companies Fund has got a 2.6% weighting in Capital Health. The Australian Shares Fund is a 1.4% weighting. The High Conviction doesn't hold. It's under a minimum market capitalisation limit, so it is ineligible for the High Conviction Fund. But just a nice, solidly valued healthcare company. This is another long-term investment. We've had this investment within our funds for around 8 years. It's a company called Contact Energy. Look, it's vertically integrated energy provider. It generates electricity largely from geothermal, from hydro uses. Around 85% of its generation is from renewables. It's playing an important role in terms of the transition. It's building a large geothermal kind of project around in the middle of the North Island in Taupo, whereby it's spending $800 million, and it's contracted a chunk of the generation to the largest gas-fired generator in New Zealand, Genesis Energy. So look, it's playing that part in the transition. Look, it's got a strong balance sheet. It's a good dividend payer. We like dividends, and it's trading at a reasonable discount against peers. And these types of assets, in an Australian context, would probably be owned by the large super funds or private equity. And the opportunity through buying in New Zealand is two of the top three, or actually three of the top four government-controlled entities, 50% owned by the New Zealand government. Contact is one that's not actually owned by the New Zealand government. It's 100% free float, and it's probably the most attractively priced of the renewable energy kind of options in New Zealand. Just in terms of weightings, we've got strong kind of weightings in the Emerging Companies Fund and the Australian Shares Fund. These are very these funds are very highly diversified. Emerging Companies Fund typically has 60 stocks. Australian Shares Fund around 70 stocks. The High Conviction has less stocks, but it has a decent weighting in Contact Energy. So we're quite kind of positive about this company. It's a good member of the portfolio, providing yield, on the electrification journey, and playing an important role.
And the last one we'll just touch on is PEXA. So it is one of the other active positions across the funds. So PEXA is the digital platform that helps banks and consumers settle on a property transaction in Australia, as well as sending messages to the land registries. So we really like the Australian business. It's reached a nice level of penetration and profitable scale. It's generating free cash flows, and this has helped funding their growth options and expansion into the UK. It's got nice fixed cost leverage. So each incremental dollar of revenue in Australia is high gross profit margin, as a platform is scalable and benefiting from that fixed cost leverage. So the position in Australia is leading in a defensible market position, and the platform is now kind of integral to digitalised settlements. So it's helping to improve efficiencies across the industry. And although there may be cyclical slowing of property over the next year, we think this is opportunistic time to add, and analyst expectations do factor in a slowdown in transaction volumes. So just remembering that their revenue is per exchange or settlement of a property rather than property prices per se. So where we kind of see the difference versus the market is we think at the current share price, nil value is being ascribed to the growth option. So whether that be in the data analytics or the UK. And we think we're getting that free option for that international growth story in particular. PEX has spent some considerable time in the UK, and we believe they'll start to do refinancing transactions at the end of this calendar year. In fact, this morning they confirmed this with two parties, and we'll start to see penetration of the UK market thereafter. So the UK story, when we see that traction, it's a much larger than the size of the Australian total addressable market. And finally, you know, within all of these stocks, we rate management highly. So the management has a very disciplined kind of expansion strategy, and the cash generation from the Australian business is nicely funding that growth potential offshore in particular.
Thanks, Dee.
Hi everyone, welcome back. Thank you so much to Mike, Andy and Deana for their updates today. We have had a stream of questions coming through, which I've tried to be across over the course of the webinar, and I would encourage you in the final few moments of the webinar, if you do have anything else raised, please put it into the Q&A. Deana, there was something in relation to your update around the tech sector. And I'm sorry, I was furiously typing an answer to a question, but one of the participants has asked, you mentioned stickier when it comes to, and I wasn't quite sure in respect to that, but could you elaborate on sort of what you meant by that in relation to the tech sector?
Sure. Just in terms of stickier, we're looking at, you know, some software metrics. One of them in particular is annual recurring revenue. And the metric on stickier is net revenue retention or churn. So essentially when we're saying stickier, we're looking at the recurring nature of the business and how sticky those clients are to kind of utilising that software and embedding that software, particularly at an enterprise level within their business processes. You know, PEXA is one example where it is kind of at the moment a very strong dominant market position in where it is, and it's very sticky, although it's transactional, is sticky revenue. So they're the kind of things that we're talking about when we're talking about how sticky the revenue base is.
And look, I'll just chime in there. This really goes to the heart of the first thing we look at from a financial perspective when we evaluate a company, is that we need to be sure that the earnings or the business model has a repeatable revenue and earning stream in the long term. So even though, you know, we may invest in advance of them achieving that, we have to believe that the business model is capable of achieving recurring revenues, because there are examples of companies, you know, that financially engineer themselves and over leverage or have very lumpy hardware style revenues, and they're not the sort of companies that we really want to back for the long term.
For some of these software companies that are trading on kind of 1 to 2 times EV to sales, and the revenue is sticky, you know, the projected EBIT multiples for some of these stocks at the now is probably 6 to 7 times. So that's where we're seeing kind of opportunities across the tech sector selectively. Thanks, Leah.
No problem. Thanks, Deana. There was another one here, which is probably a slightly more technical portfolio management question that one of you might want to pick up. To what degree does the Australian Ethical Investment team use the 19-year real estate cycle, referencing Harrison Anderson, Cashmore et al.? I'm not sure who might want to take that, or if we want to take that offline.
I'm not familiar with the piece, but I'm going to go and look it up now in case we're missing something. So, Andy, what about you?
Look, I'd say we don't use it because we've never heard of it. But you know, and to be honest, in terms of real estate, look, we've got a little bit of Mirvac and Stockland, and technically PEX is in the real estate sector. even though it's a technology company. But yeah, real estate's not really an important kind of focus within our investment portfolios.
Thanks, guys.
Look, typically we're underweight banks as well across the strategies, and so again, you know, when you may think of banks as another form of leveraged real estate exposure.
Thanks very much, Mike. And I know there have been a couple of questions along the way, more from an ethical point of view around financials and banks, which I have responded to, but we're happy to go a little bit deeper. And certainly I would encourage you to jump online in 2 weeks' time with our head of ethics, Dr. Stuart Palmer, and his team. It is a really challenging space and something that we do keep a very close eye on and scrutinise from an ethical perspective quite often. There was actually a question here, which I'll respond directly to, but it was around dividends payable. Now, I think it was more from a fund and a structure point of view, but I just thought it might be an opportunity. You know, how do you think about dividends when you're sort of looking at stocks, and how does that play a part in choosing stocks or portfolio construction and things like that? Is it an input? Is it a consideration? I don't know, Mike, if you have a view on that.
Look, I think what we're really interested in is sustainable dividends. And, you know, I mentioned before about, you know, we're very careful to make sure that the companies we're investing in have a recurring style business model, at least and so we don't really encourage companies just to pay dividends for the sake of it, because sometimes you can be, you know, robbing the future just to pay a high dividend now. But all things being equal, having said that, you know, we do like companies that are able to pay a growing dividend through time, because often it's reflective of stability in the view that management has about the future of that company, and it can be a meaningful part of your return as a long-term investor. And so when we look across the strategies, you know, obviously the smaller capitalisation companies probably pay lower dividends on average, is because it makes sense for them to be investing in what is often rapid growth. If we looked at the high conviction fund, there was a question on there about how the fund's different. That does have a bit more yield. You know, it would have around about a 4% yield before franking on that strategy. I don't know, Andy, do you want to add anything to that?
Yeah, look, not a lot, but we love dividends, and it's probably our investable, our screened universe is overweight growth, which probably you know, where dividends are a less important components of shareholder return. So, but you know, any company that's paying us a healthy dividend, you know, we're pretty pleased with that.
Awesome, thank you. I'm just having a really quick look at the remaining questions. We are right on time at 1 o'clock, and I don't want to keep people past that time. And I think the majority of them we can actually respond to. I mean, Mike, maybe in closing out, there is a comment or question comment around the concentration of the AE portfolio, particularly compared to the market due to the ethical screening and the small cap buyers, which I know we've spent quite a bit of time on today. You know, does that result, or is it likely to result in higher volatility and risk? You know, and they reference standard deviation and things like that, which we can respond to more specifically, but maybe just in a closing out statement.
Yeah, certainly, Leah. And I think it, you know, it's worth when we talk about concentration, worth bearing in mind that the Australian Shares Fund and the Emerging Companies Fund are actually very diversified funds of 60 to 70 stocks, so they're not very concentrated. The High Conviction Fund is a more concentrated fund of 20 to 35 stocks. So that's the first point. When we look at the volatility of those portfolios in absolute standard deviation terms, typically we're looking at volatility that is similar to the overall volatility that is similar to the respective benchmarks through time. In fact, we think over the long term we've been able to add value without increasing volatility. But however, another measure of volatility that people often use is how different do you look than the benchmark rather than in absolute terms. And we don't sort of pay a lot of attention to that, because we're not really trying to invest like the index, which is made up of big resource companies in the main. But you know, in general, that's a measure of tracking error, and that measure is, as you'd expect, is a bit higher because we don't really look like the benchmark. But in absolute terms, which is what we think matters to investors, you're typically getting volatility, or we try to target volatility in line with our benchmarks. And we can send you some more technical answers in relation to that.
I said I was conscious of time, and I am going to cut us off because it's now 2 minutes past, but I'm just conscious, Mike, that we have had a couple of questions through. I'm assuming it's probably mainly from financial planners, inquiring about the High Conviction Fund, and we didn't really spend any time on it today. It's obviously a new offering that we launched in October last year, and then launched in a managed fund version, but also in a listed ETF earlier this year. In 30 seconds, what's the High Conviction Fund really about?
Oh, look, really, you know, it's the same team and the same process. And when we looked at our long-term track record, we find that, you know, we've been able to add value across all parts of the market, whether it be micro, small, mid cap or large cap. But as you can see, you know, existing funds in the Australian Shares Fund and the Emerging Companies Fund are more small capitalisation focused funds. And we wanted to have an offering for people that were interested in a more concentrated portfolio, and that was more exposed to larger cap companies. And so we think that kind of really rounds out our range in domestic equities. And the other important part of that is we have made that accessible via an ETF structure, so you can buy and sell that fund on the stock exchange under the ticker code AEAE. And so that's just a little bit about that. But we do see ourselves as having a core expertise in Australian equities, and we really just want to make that accessible to people in different ways.
Thanks so much, Mike. And for those advisors that asked about the SMA strategy, we haven't focused on that at all today, but there is that option available on platforms for a financial advisor as well. With that, I might close out today. I thank everyone for taking the time today to dial into our webinar, and encourage you again. This is only one half or 1/3 if you look at the model that I ran through earlier in the day. We do obviously have our ethical assessment, we have our rigorous investment analysis and portfolio construction process, and then we do have outside of the portfolio, or within and outside of the portfolio, a heavy engagement and advocacy approach as well. So in 2 weeks' time, as I said, Dr. Stuart Palmer will be leading that discussion on our ethical assessment and some of the activity that we've been involved in from an ethical point of view over the last 12 months. I would round out to investors and advisors to say that it has been a challenging 12 months, in particular for us over the last 3 to 6 months. As you can see, there's a couple of things that occurred in markets, particularly where we don't have exposure because of our ethical charter in more carbon intensive things like commodities and energy, where you have seen a real run on prices. But we also have a real commitment, I guess, to that ethical heritage that we have and that ethical framework that we continue to apply. And we do think that it has long-term benefits, both from an impact perspective, but also from financial returns. So we will continue to apply the rigour around our ethical criteria, as well as the rigour around applying investment fundamentals, even through short-term market volatility. I would encourage any investors and advisors to please reach out to us post this. If you do have any questions that you'd like to ask us individually, we have teams both from a sales and a client service perspective. And also when we come back to you for some feedback post today, please be open and honest. We'd like to do more of these, and we'd like to deliver information that's valuable to you. I appreciate everyone's time. Have a great day, and thank you so much for dialing in.
Thank you.
Thanks.
Thank you very much, everybody.